Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
China. Everybody loves China. Most everybody we know loves China. We think China is going to disappoint in not a minor way, but in a huge way. We've said it before, at least this has been our view, but we are surprised how China can keep the music going. But not that surprised if we look at the latest numbers. China is just front-end loading in a huge way stimulus through their banks. They're just pouring money out as fast as they can. They're doing the things that all those nasty capitalists did during the credit crunch that they were disparaging about 6 months ago. But now that because of this, now that their exports in China continue to go lower and lower. They were negative 26% in May. Negative 26%. They've totally collapsed their exports. Again, doing your reading, basic readings, you understand China is an export-driven economy first and foremost. If exports plunged 26% because this guy is now saving 6 to 8% of his income in the U.S. and isn't buying, they are dead in the water. So all this money they're throwing into the market, if exports don't rebound, and the U.S. consumer is not going to be motivated by the stimulus thrown into Chinese infrastructure. If this doesn't rebound, these exports continue down, China is dead in the water, and we think they're in panic mode, and we think this is part of that crackdown process and why we're starting to see the revolts and incidents in China. But we think China is going to disappoint in a very, very big way. That's part of our story, and has been for the last couple months. If they do, we think it could trigger an emerging market crisis. People have moved back into the emerging markets on this green shoots idea, on the V-shaped recovery, on China's stimulus taking us out. A lot of money has moved back into the emerging markets where it shouldn't, because the emerging markets aren't necessarily in any better shape. And keep in mind, people are so in love with this BRIC idea. BRICS don't have enough demand to drive a global economy. The U.S. consumer is the driver. The BRIC economies depend on demand. They depend on exports. So if China disappoints, the emerging market money will come rushing out. And if it does, we'll see a similar pattern that we saw before. Money will come out of China. Money will come out of emerging markets very, very quickly. And there's a lot of money that's moved back in very, very quickly. It's because, and you saw that in the move up in markets. As that comes back down, the U.S. that money coming out of the emerging markets and out of China will go back into the U.S. capital markets to hide. And that's where we think is the driver of our major risk bid. Capitulation emerging markets, money flowing back out of China. You notice the huge move in the Japanese yen in the last several days, and the fact that the fundamentals are just awful, but the Japanese yen started to move a lot faster as concern started to rise over politics in China. We think money is starting to move out of China, or at least out of Asia, and hide in the yen again as a safe haven. The yen and the dollar do very, very well in a risk bid. It just so happens the yen has been doing better of late, even than the U.S. dollar, on some of this minor risk bid we've seen. The emerging market crisis hits. That exposes the Eurozone banking system because of their incredible exposure to emerging markets. Doing your reading, you would have found out that in terms of emerging market lending around the world, Eurozone banking system represented $3.7 trillion of all lending at the end of 2008. U.S. banks represented $625 billion. $3.7 trillion exposure to emerging markets in Europe versus $625 billion in the U.S. Which banking system is going to do the worst if we see a capitulation back out of the emerging markets? The European banking system. And that flows directly into the euro. So without even looking at the charts, and you have this fundamental view, what would be your scenario? You're probably going to get rid of the commodity currencies as this view starts to play out, because they're the ones that get the most bang in a risk appetite world when people are moving money offshore into China and commodities are blowing and going. So your move would be if you believe in this risk bid, is to position into Australian dollar calls, AUX. You're buying US dollar, Australian dollar calls, and you'd also be buying Canadian dollar, US dollar, Canadian dollar calls. The root symbol CDD, you can use these two in order to find the options available, chains available in the ISE. Also, the euro being the mirror image of the dollar, emerging markets break in our fundamental view, it has to hit the euro much harder. The yen probably continues to rally, again, as a safe haven of money coming out of Asia that doesn't want to go into the dollar that will tend to hide into the yen. Let me show you some of these charts, and just to show you also how the bonds can factor in here in terms of, again, your overlay. This is the U.S. bond market, and the point I wanted to make here is you see how the U.S. bonds started to rally. This is the credit, when the credit crunch started to rear its ugly head. These are bond prices on the black line. This is the U.S. dollar index, the red line. So there's where we started to see money moving into the U.S. bond market in order to hide. Did they like anything that was going on in the U.S. economy? Absolutely not. Did they like the dollar? International and big investors that needed to hide a lot of money? Absolutely not. But as they started to buy more and more bonds, they had to buy the U.S. dollar at the same time. So we saw a giant risk bid in U.S. dollar. Notice how they've come down together. All right, as the bond market's loosened up, money's moved offshore. The price of bonds is falling. The yield has gone slightly higher, loosening up of the credit markets a bit, money moving back short. See how tight this correlation is. So there's just, again, another simple correlation you can look at, because you'll be following interest rates in your global macro reading. This is a little esoteric. I won't spend too much time, but one of the things I want to show you is the VIX. VIX is the volatility index of the S&P. Is another thing that we look at. And as volatility starts to come off, the U.S. dollar tends to move down with it, because this falling volatility means global growth is there, credit markets are loosening up, growth is there, everything's starting to get back to normalization. And of course in that normalization, stocks up, stocks are the blue line here, commodities are pink, stocks up, commodities up, dollar down. See how simple these correlations are. But what's also you got to keep in mind, these correlations are so tight that nobody really has any diversification. What's going to happen again if we get another risk bid? Where are they going to go? Again, they're probably going to go back into the bonds. They're not going to hide back in oil, because oil prices have already rebounded 100%, off of their low. They're not going to necessarily hide there. So all these tight correlations that you can do in your simple overlays, which match the global macro view of green shoots, start to give you some information about if the trend changes, where should I put in? Where should I be? The other muddle through scenario, this is our secondary scenario, and it's very plausible, and it's in the market, and it very much could play out. So our primary scenario is slightly ahead of this one, and it's pretty tight. So we're watching very closely to see if we're going to be wrong, and if we're going to be wrong, we have to flip quickly. The U.S. seems to want to be playing the role of stimulator of last resort. They believe in this idea that China is going to lead us the way out, or they believe in the idea that China has to lead us the way out. We have to get back into that symbiotic relationship of China pumping out goods, of China buying U.S. treasuries, of U.S. dollar going offshore to juice those asset markets as they did in the past, as I showed you in those charts. The dollar is the world reserve currency. Keep pumping it out there, build up those asset markets, build up the stock markets, hopefully get a rebound in the U.S. housing market, so that you have the housing market and the stock market potentially moving in the same way. That's a wealth driver, and the U.S. consumer starts to get more confident and starts to spend. As he spends, China then becomes the leader in the way out, because China export demand increases dramatically.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.